in today's market, investing your hard-earned money can feel like a roll of the dice.
Local financial instructor Michael Masserant from Retirement Education Foundation here to clear up some of the biggest myths that maybe keep people on the sidelines. Let's start where we were in the commercial break, because a lot of people say, why would I gamble with my money when it comes to investing?
Yeah, so this is something we hear a lot in the class, and this is one of, I was telling the two of you, this is one of my biggest pet peeves, is that people, when they compare investing to gambling. Now, here's the deal. If someone is stock picking or day trading, that is gambling. If someone is stock picking or day trading, they're likely going to lose their wealth and not grow their wealth. But if someone is investing for the long term, if they are buying the diversified index, buy the basket of stocks and hold it for 10, 15, 20 years, statistically speaking, 99% of the time, you are going to make money in the long run. That is not gambling.
And you can't outsave inflation or cost of living over a period of a number of years.
Yeah, that's one of the myths and misconceptions. Some people say, well, I don't like risk. I'm just going to put my money in the bank account and call it a day. I'm getting, 3.5% of my savings account. That's pretty good, right? And that is pretty good. But if you're getting 2 to 3.5% on your money in a savings account, that is not going to help you build wealth and outpace inflation. Inflation steals from us, all of us, every single day with our purchasing power. Money, $100 20 years ago does not purchase the same $100 worth of goods today. So we can't just put the money in the bank account. We've got to invest the money and grow the money to outpace inflation.
Is there an age, though, where it's safer to save as opposed to invest, or can you start investing at any age and still have a big payoff?
So the more time you have to invest the money, the more you're going to earn in the long run. If someone had invested $10,000 30 years ago, that $10,000 would be approximately, and this is in the S&P 500, that $10,000 would be worth roughly $230,000 today.
It's pretty incredible.
And that 30-year period, we saw the dot-com crash, we saw the housing crisis, we saw the 2019 crash, the 2020 COVID crash, the 2022 recession. We saw all these events, and still, if you just bought the index 30 years ago and held that money, you'd have $230,000 today.
And Michael, we just flashed on the screen, one of the biggest myths is that you have to be rich to invest. That's not true. I mean, you could be making 50 grand a year and have a much better outlook financially than somebody making 150 grand a year, just depending upon what you choose to do with your investments.
Yeah, I mean, I would argue, honestly, for anyone, it's even more important to be investing if you are struggling to build wealth, because that's the fastest way to build your wealth. And some people say, well, I didn't have $10,000 30 years ago to invest. I get it, but you have some wealth today. Maybe you only have $100 or $10 or $1,000. Just start now, because 30 years from now, you'll be thanking yourself today for starting when you did.
Where do you start? Do you have to constantly watch the stock market to be successful? Some people are watching, they don't know exactly what they're looking at, so it feels intimidating because you don't know when is the right time to jump in.
For sure. So for a lot of people, it is intimidating at first, but there's so much good education out there now. So ideally, you shouldn't be watching it almost at all. The people who do the best in the stock market are the people who just put the money in the account, they buy the index, and they don't check it. Because if you are checking it every day, every week, every month, your emotions will get the better of you. I don't care how calm, cool, and collected someone thinks they are. When it comes to your money, your emotions will take over if you let them. So having a plan, a long-term plan, is the goal.
And just within this year alone, proof of that is 6 months ago, we were joking about 401ks becoming 201ks, and now they're up 15% in many cases, just in that singular year.
Exactly. And so to your point, this April, we saw the stock market fall almost 20% in a month.
And people are freaking out.
People were running around like crazy, panicking. And today, to your point, we're up 15, 16% this year. So if someone had panicked and sold their investments back in April, they would have been down 20%. They would have missed the recovery and the 16% growth. That's a life-changing mistake. And so we can't let our emotions get in the way of those things.
Does it depend on how old you are? Because I also think that might scare people as well, or maybe feel a little dismissive. And please correct me if I'm wrong. But there are people who, things are happening, crashing, at the time when they are looking to pull the money out?
It really does depend. You're totally right. So if someone is 25, that when this past crash in April happened, if you're 25, you've got 30, 40 years for this money to recover. Just don't panic. If someone is 55 or 60, it's a whole different game plan.
Exactly.
So when you're younger, it's really simple. Just dump the money in the indexes, close your eyes, and 30 years later, you're going to have a lot of wealth. When you're in your 50s or 60s, you got to have a game plan to understand when am I spending this money and how should I invest, maybe a little safer.
Michael Masserant, Retirement Education Foundation, refedu.org is the website if you want more information. He is not Alan Longstreet, but sorry,
just as tall,
just as tall and just as handsome.
Absolutely.
But you can go check out Michael and the entire team over there at the Retirement Education Foundation. Thank you, my friend. We appreciate it. All right, refedu.org. We'll be right back. Tall and handsome.